Imagine your wealth trapped inside a concrete monolith, slowly sinking into the mud under its own massive weight. For most people, this is exactly what their largest financial commitment feels like. True alternative investing relies on a simple, unforgiving rule. You must separate assets that generate yield from liabilities that drain your capital. Yet the standard retail playbook tells us the exact opposite. We are taught that buying a house to live in is the ultimate path to generating wealth. But the reality is, a property you occupy produces exactly zero independent yield. What looks like an asset is actually bleeding cash. You pay continuous maintenance, local property taxes, and compounding mortgage interest. A physical property only earns the title of asset when it produces positive cash flow, where rental yield strictly exceeds debt obligations. Without that positive cash flow, a physical property is simply a lifestyle expense masquerading as an investment strategy. If you want to extract actual value from real estate, you generally have two paths. The first is prioritizing pure cash flow. Investors achieve this by stretching their loan tenures to the absolute maximum limit. A 35-year mortgage artificially shrinks the monthly installment barrier, making it much easier for rental income to clear the hurdle and put money in your pocket. The second path is capital appreciation, commonly known as flipping. This involves hunting for distressed assets, often at auction, and holding them just long enough to time the exit and avoid aggressive real property gains taxes. Both strategies work, but they require discipline. And that brings us to the systemic danger threatening modern retail property buyers: artificial leverage. Developers increasingly offer cash-back property schemes. They market this as a massive discount or a signing bonus, but it is actually a highly leveraged debt trap. Let's look at the math. A developer takes a baseline property worth $400,000 and sells it to you for $700,000, handing you a $200,000 cash payout. You instantly absorb a $300,000 gap of negative equity. That borrowed money artificially inflates your monthly debt obligation. The required mortgage payment absolutely crushes the potential rental yield the property can realistically generate. If you try to sell, you'll find the secondary market only recognizes the true $400,000 value of the asset. When the heavy friction of physical real estate meets artificial leverage, your downside risk multiplies. Your capital is now trapped in an illiquid, deeply underwater asset. To escape this physical friction, capital markets engineered a specific mechanism: securitization. Securitization is the process of unbundling a physical asset. It extracts the cash flow and strips away the direct burdens of ownership. In real estate, the primary vehicle for this is the Real Estate Investment Trust, or REIT. When you buy a REIT, you are not buying a concrete wall or a leaky roof. You are purchasing shares in a property management company that handles those problems for you. The healthcare sector provides a perfect case study for this structural advantage. For an individual retail investor, independently buying land, building a medical facility, and outfitting it with specialized infrastructure is an impossible capital barrier. But through a securitized alternative like the Al-Akar REIT, that hospital is fractured into shares. You immediately capture the dividend yield of established KPJ hospitals, completely bypassing the operational overhead. This model scales to megastructures. Through the KLCC REIT, you can own a fraction of the Petronas Twin Towers, an asset you could never acquire individually. Securitization democratizes access to institutional-grade yields. It entirely strips away the friction of physical maintenance and the danger of illiquidity. This same unbundling applies to corporate debt through fixed-income alternative assets, specifically Islamic bonds known as sukuk. On one end of the spectrum, you have government-backed debt, like the Dana Infra Sukuk. It offers a low-risk, lower-yield profile. On the other end, you find high-risk, high-yield alternatives, such as corporate convertible loan stocks. The aerospace sector clearly reveals the underlying vulnerability of these high-yield instruments. When an external macro shock hits, it can instantly destroy the underlying cash flows a company relies on to service its debt obligations. This chart illustrates the speed of a systemic shock. During the COVID-19 lockdowns, airline revenues dropped to zero. In a matter of days, their high-yield financial instruments were severely degraded, taking on the risk profile of junk bonds. Companies in this position are forced into severe restructuring. They issue new debt just to pay off the old debt, a financial cycle of digging a hole to cover a hole. In fixed income securitization, a higher yield is not a reward for your bravery. It is an exact measurement of the probability that the corporation will default during a systemic crisis. When you trade physical bricks for digital shares, you gain instant liquidity, but this immediately creates a new paradox. By solving the friction of physical ownership, your capital is now fully exposed to instant market volatility and extreme sentiment swings. While broad technology disruptions play out over years, the immediate danger comes from syndicate-driven speculations, commonly known as pump-and-dump schemes. Retail investors routinely get trapped buying into a stock at the absolute peak of an artificial spike. Days later, the syndicate flushes the liquidity, wiping out the asset's value. To navigate this speed, market practitioners rely on a specific technical heuristic, the 200-day moving average. This metric acts as a dynamic support line. It filters out daily noise, separating a legitimate macro uptrend from a structural downtrend. When the price decisively breaks below this 200-day average, the trend is broken. It is a strict signal to exit. In highly liquid markets, technical indicators like this are your only objective defense against emotional trading and speculative traps. If you operate within the Islamic capital markets, you face one final layer of structural complexity, the Sharia-compliant constraint. Standard global investors mitigate volatility by heavily relying on broad market ETFs, like the S&P 500, to safely disperse their risk across hundreds of equities. But strict Islamic screening filters out these broad index vehicles. Because they include conventional banking and prohibited sectors, the entire fund is blocked at the gate. Only isolated, compliant equities are allowed to pass through. This restriction removes the easy safety net of passive index investing. It forces the Islamic investor toward active, single-stock analysis. Fortunately, several major global technology equities successfully clear the screen and maintained compliance. This dynamic group includes highly volatile yet fully compliant global megacap stocks. To achieve benchmark returns, a Sharia-compliant portfolio must perfectly balance these specific individual equities with targeted Islamic REITs and government sukuk. While this constraint takes away the broad market ETF, it forces a higher degree of rigorous, intentional asset selection. It transforms the investor from a passive participant into an active risk manager.